Tonight we're breaking down a decision that affects your wallet, your job, and the entire U.S. economy. Whether you're a student, a parent, a business owner, or just someone trying to make ends meet, the choices made by the Federal Reserve have a direct impact on your daily life, even if you've never thought about it before. We're talking about the Federal Reserve's move to cut interest rates, a decision that can change the way we all spend, save, and borrow money. The Fed, our nation's central bank, is like the financial referee for the U.S. economy. Its job is to keep things running smoothly by managing the money supply, overseeing banks, and making sure the financial system stays healthy and stable. Its most powerful tool? Adjusting interest rates, the cost of borrowing money. This single lever can influence how much you pay for a car loan, a home mortgage, or even your credit card balance. The Fed controls the federal funds rate, which is the interest rate banks charge each other for overnight loans, but its effects ripple out, influencing everything from your mortgage to your credit card, student loans, and even the interest you earn on your savings. When the Fed raises rates, borrowing gets pricier. That means people and businesses are less likely to take out loans, so spending slows down. This helps keep inflation, rising prices under control, but it can also make it harder for families and companies to afford big purchases. But if rates go up too much or too quickly, it can tip the economy into a recession. Businesses may cut back, jobs can be lost, and growth can stall. On the flip side, lowering rates, as the Fed did today, makes it cheaper to borrow. This encourages businesses to invest in new projects, hire more workers, and helps families afford things like homes and cars. It can also make it easier for people to pay off debt or start a new business. The goal is to keep the economy growing at a steady pace, creating jobs and opportunities, but without letting prices spiral out of control and hurt your purchasing power. Today's rate cut is meant to give the economy a boost and prevent a slowdown. It's a balancing act. Stimulate growth, but don't let things overheat. Understanding this helps explain why the Fed's decisions matter to everyone, not just bankers or economists. These choices shape the job market, the cost of living, and the opportunities available to all of us. Whether you're saving for college, buying your first home, starting a business, or just trying to stretch your paycheck, the Fed's moves ripple through your daily life in ways you might not even notice at first. So, as we watch how this decision plays out across the economy, remember, the Federal Reserve's actions are more than just headlines. They're decisions that touch every corner of American life. The Fed doesn't cut rates on a whim. It's a calculated move to counter signs of economic weakness. Every decision is backed by months of data analysis, economic forecasts, and careful debate among policymakers. When the economy shows signs of slowing, like weaker job growth or declining business investment, the Fed steps in to help steer things back on course. Cheaper borrowing means businesses can invest, expand, and hire, creating jobs and fueling growth. Lower interest rates make it easier for companies to take out loans for new projects, buy equipment, or open new locations. This ripple effect spreads across industries, from tech startups to manufacturing plants, helping to energize the entire economy. Lower rates also put more money in consumers' pockets, boosting spending on everything from groceries to vacations. When monthly payments on mortgages, car loans, and credit cards drop, families have more disposable income. This extra cash often goes right back into the economy, supporting local businesses and services. This spending encourages businesses to produce more and hire more, creating a positive feedback loop. As demand rises, companies ramp up production and bring on new workers, which in turn puts even more money into circulation. The Fed's third rate cut this year signals concern about slowing job growth and global economic headwinds. International trade tensions, unpredictable markets, and shifting consumer confidence all play a role in the Fed's cautious approach. By acting now, the Fed hopes to cushion the economy against a potential downturn. Proactive rate cuts are designed to keep momentum going, even when uncertainty looms on the horizon. It's like taking out insurance, stimulating growth before trouble hits. The goal is to build a buffer, so if the economy stumbles, the impact is softened and recovery is quicker. The ultimate aim? Achieve a soft landing, slowing inflation without triggering a recession or spiking unemployment. It's about guiding the economy to a stable, sustainable pace, where growth continues but risks are kept in check. But it's a tricky balance, and every move is a high-stakes judgment call. The Fed must weigh the risks of acting too soon against the dangers of waiting too long, knowing that each decision affects millions of lives. The Fed's challenge: guide the economy towards stable growth and low unemployment, despite uncertainty. It's a constant balancing act, requiring vigilance, flexibility, and a deep understanding of global trends. Each rate cut is a bet on keeping the recovery alive, a strategic move to ensure the economy keeps moving forward, even when the path ahead is unclear. The Fed's third rate cut of the year, lowering its benchmark to 3.75%, was expected, but not without controversy. The vote was split, with 3 top officials dissenting, the most divided decision in years. Some wanted a bigger cut, fearing a downturn. Others argued the economy is still strong and further cuts risk inflation. This division highlights just how uncertain the outlook is, even among experts. Chair Jerome Powell must now steer policy through disagreement and keep markets and the public confident. The Fed's next steps will depend on whether these cuts are enough to keep recession at bay. The Fed's rate cut is driven by a weakening job market. Job growth has slowed to just 40,000 new jobs a month, barely enough to keep up with new workers. Fed Chair Powell even suggested official numbers may be overstated, hinting at possible net job losses. This signals businesses are hesitant to hire, a classic warning sign of economic trouble. Meanwhile, inflation remains stubbornly above the Fed's 2% target, partly due to tariffs. The Fed faces a tough challenge: stimulate a slowing economy while battling persistent inflation. Political pressure adds to the difficulty, with President Trump demanding faster, deeper cuts. The Fed's independence is being tested as it navigates economic and political minefields. Weak job growth, high inflation, and political attacks make this one of the toughest periods for the Fed in years. The stakes for American workers and families couldn't be higher. A looming revision to job data could reveal the economy is weaker than we thought. Early estimates suggest up to 900,000 jobs may be erased from last year's totals, a historic correction. This would confirm fears that the job market's strength was overstated and that economic growth has been eroding quietly. For the Fed, it validates the decision to cut rates preemptively. The challenge is compounded by recent data gaps caused by a government shutdown, forcing decisions with incomplete information. Corporate layoffs are up, and wage growth is slowing, especially for lower-income workers. The benefits of growth aren't being shared equally, and the most vulnerable are falling behind. These signs point to an economy where risks are rising beneath the surface. The Fed's actions are an attempt to address these hidden weaknesses before they worsen. The Fed's rate cut isn't just news, it affects your daily life in ways you might not even realize. When the Federal Reserve changes interest rates, it sends ripples through the entire economy, touching everything from your monthly bills to your long-term financial plans. Lower rates mean cheaper mortgages, car loans, and credit card interest, saving you money if you borrow. If you're thinking about buying a home, refinancing, or even just carrying a balance on your credit card, you'll likely notice your payments getting a little lighter. This can free up cash for other expenses or help you pay down debt faster. But savers will see lower returns on savings accounts and CDs. The interest you earn on your emergency fund or retirement savings may shrink, making it harder to grow your nest egg. This can be frustrating for those who rely on interest income, especially retirees. The trade-off is clear: borrowers benefit, while savers earn less. It's a balancing act that affects people differently depending on their financial situation and goals. Rate cuts are also meant to boost hiring, so if you're job hunting or worried about layoffs, this is good news. Lower rates encourage businesses to borrow and invest, which can lead to more job openings and greater job security. More jobs and stronger growth can give workers leverage for better pay and benefits. When companies compete for talent, employees may see raises, promotions, or improved workplace perks. But there's a risk. If the economy heats up too much, prices could rise faster, making life more expensive. Everyday essentials like groceries, gas, and rent might cost more, stretching your budget. The Fed is trying to walk a tightrope, stimulate growth without letting inflation get out of hand. It's a delicate balance, and even small changes can have big consequences for families and businesses. For most Americans, it's a balance between cheaper loans, job security, and the cost of living. Every rate change can shift this balance, so it's important to pay attention and adjust your plans as needed. The Fed's decisions shape your financial future, whether you're borrowing, saving, or working. Being aware of these changes can help you make smarter choices about spending, saving, and investing. Understanding these moves helps you make smarter money choices, so you can protect your finances and plan for what's ahead. Wall Street cheered the Fed's rate cut. Stocks soared, with the Dow jumping over 500 points and the S&P 500 hitting a record. Investors were relieved the Fed signaled no rate hikes soon, providing stability and predictability. The Fed also announced it will buy $40 billion in Treasury bills monthly, adding cash to the financial system. While called a technical move, markets saw it as another sign of support. Lower rates make borrowing cheaper for companies and boost stock appeal over bonds. The rally shows how much investor confidence depends on the Fed's actions. By delivering what markets expected, the Fed reassured investors it's committed to supporting growth. This optimism is a vote of confidence in the Fed's ability to steer the economy away from recession. But the real test will be whether these moves translate into stronger growth and jobs. For now, Wall Street is betting on the Fed's steady hand. The Fed's decisions this year have come under intense pressure from President Trump, who's demanded deeper, faster rate cuts. This challenges the Fed's independence, a cornerstone of sound economic policy. Economists warn that political interference could undermine the Fed's credibility and effectiveness. With Chair Powell's term ending in 2028, the White House may soon shape the Fed's future leadership. Despite the pressure, Powell insists the Fed's decisions are based on data, not politics, a message crucial for public trust. After 3 rate cuts, the Fed is hitting pause, waiting to see if the economy stabilizes. Officials expect to hold rates steady through next year, with only one more cut likely in 2026 and another in 2027. Inflation is expected to stay above target until at least 2028, meaning higher prices may linger. The Fed's priorities support jobs, even if it means tolerating higher inflation for a while. For Americans, this means a slow-growth environment with fewer rate changes and modest wage gains. The Fed's cautious approach aims for stability, but leaves little room to respond if new risks emerge. The path to lasting prosperity remains uncertain, but for now, crisis has been averted. The Fed's next moves will shape the economic landscape for years to come.